Good morning to you. We think it's the right time to buy now. I mean, the markets are not going to go straight back up, in one upwardly sloping line. We know we've had 3 days where consistently that has happened, but you should expect volatility along the way. But I mean, look at what the market has priced. If we go back to the beginning of 2021, the market was expecting one hike by the end of 2023. It's now expecting some 8 hikes plus balance sheet reduction. That in turn has impacted the equity multiple when we saw 23 times forward earnings for the S&P in June of last year, and that went all the way back down to 19.5, and that's only 1 point higher than the 5-year average. So, that the market has traveled an awful long way in terms of digesting higher inflation, digesting a tighter labor market, and what that means for the multiple. In the meantime, corporate earnings have remained very robust, and particularly for some of those large sectors like tech that drive the S&P, as we got some data points overnight. So we think it is right to buy. We're buying, the broad S&P. We're also adding to technology positions, and we're adding to financials. But we also do expect more volatility along the way than we've experienced over the last 18 months.
In correction territory on a lot of decent markers, for instance, the Dow Transports, the Russell 2K as well. I just don't see how those kind of companies, the broader brush companies you mentioned as part of your S&P 500 strategy, how they're going to proliferate and how they're going to outperform when, as you say, valuations are cheaper, but they're not cheap by any way, shape or means. They're just cheap compared with the last year or so.
No, I think you're absolutely right on that. And what we're looking for is growth at a reasonable price, or GARP, as we call it. Now, that growth can come from more cyclical parts of the market, like industrials, where we see strong drivers, for an example, through decarbonisation and a strong capex cycle that we're seeing. The growth can also come from more compounding sectors like healthcare or technology. But the parts of the market that we certainly want to continue avoiding are those more unprofitable, more aspirational or speculative parts of the market, because we still think rates rise from here. Financial conditions are going to tighten still. As we know, we haven't even begun yet the hiking cycle. And therefore, that downward pressure on valuation is here to stay. And so you need corporate profits, you need cash flows, share buybacks, the ability to invest and innovate with line of sight of a good return on that investment. And they're the kind of companies that we're looking for. So increasing selectivity within sectors, within indices is incredibly important. But at the same time, that the broad S&P, we do think, as I say, on valuation metrics, is also the right place to be at the moment.